Welcome to Crescat's live market call featuring our macro and activist mining research. I'm Kevin Smith, Crescat's founder and chief investment officer. Before we get started, please refer to our important disclosures pages on the screen now. These can also be found in the description on Crescat's YouTube channel and also up on our website. Crescat's live market call is about sharing timely macro and newsworthy geologic updates, both positive and negative news across our holdings as they arise. These videos represent the opinions of Crescat as a mining and exploration industry advocate. Our objective is to share the overall geologic progress of our activist strategy in creating new economic metal deposits in viable mining jurisdictions around the world. If you enjoy our videos, please click on the like button and make sure you're subscribed to our YouTube channel to get notified of upcoming episodes. You can also follow Crescat Capital on Twitter for ongoing macro research and important news updates on our activist metals positions. If you want to learn more about Crescat's investment strategies, we encourage you to reach out to Marek Iwahashi. His contact information is on the screen now and can also be found on our website at crescat.net. So let's get started. So today, last night actually, we had earnings from both Microsoft and Alphabet. I think people know that one of our themes here at Crescat and our long, short, and global macro funds is we're pretty bearish on the Magnificent Seven, on mega cap tech stocks, and really. A number of these names had really started to roll over, really going into last Friday, a week ago, when I think NVIDIA had lost several hundred trillion of market cap in one day alone when it was down. Several hundred billion of market cap in one day alone when it was down, 10%. But there's a lot of excitement about Microsoft and Alphabet's earnings today because they beat on revenues and earnings, and both of them showed growth in their cloud business. This is what competes with Amazon Web Services, with all of the frenzy and spending going on in AI right now. Cloud is a booming business, and Microsoft and Google have always been trying to compete with Amazon in the cloud. They've been number 2 and 3, and it's my contention that Amazon is going to be much more competitive than these two companies. And these are monopoly companies. I'm talking about Microsoft and Google and their respective businesses that are used to very fat margins and in their advertising and search, and in the case of Google and Microsoft with its operating systems and Office products. So going into the cloud is a new thing, and they are benefiting from all the spending in AI right now, and that's great. And they're showing some growth, but they're also showing is huge investment in CapEx. That there is no guarantee that they're going to get a return on this investment, especially going into the cloud and trying to compete with Amazon. Now look at the free cash flow estimates on both Microsoft and Alphabet, and this is after today's earnings. This is the free cash flow estimates for and Microsoft's got a June fiscal year, so it's like June 2024 and June 2025, and you can see that after the earnings came out, the estimate is going down for free cash flow for next year. Not only that, the estimates have been coming down for 2 years straight already, and it's not getting any better. Same thing with Alphabet. Look at it. Look at how the estimates came down again for Google's free cash flow. To be fair, Microsoft did beat on free cash flow this quarter. But the analysts were looking for a negative year-over-year comparison, and they actually had positive. But look how these estimates have been coming down since the market peak at the end of 2021, and the valuations of all these Magnificent Seven, collectively have gone to new highs at the same time as the fundamentals have improved in the short term, but the outlook, especially on the free cash flow side of things, does not look good, and the valuations are still stretched as can be. Let's go on to the next. We've updated this chart here to show the enterprise value relative to GDP of the top 10 tech stocks. And I know we showed this chart many times, and I'm going to keep showing it. I'm going to keep updating it because I think we have hit that double top peak already. I think we're coming off of it now, and Google is the only Mag 7 stock that's at a new all-time high right now, and many of the others have rolled over already. Yes, we're seeing a good reaction to the earnings. I think it's a big, of the two stocks I just mentioned, I think it's a big head fake. We'll see. We'll see going into next week. I want to say, one other thing. The whole concept about this chart really is to say that when you have such incredible market share and valuation relative to the entire economy, and now you're a target of antitrust legislation and competition disruption from artificial intelligence itself, and like we were showing with the free cash flow, these companies are having to increase their spending, so the growth is decelerating across the board, but all of these companies collectively are trading as if they are going to grow faster than the economy, but they're priced collectively as if their market value is implicitly pricing that all of these companies collectively are going to be able to grow faster than the economy, and it's just impossible because these companies are the economy. What we showed, how they peaked out at the peak of the tech bubble in 2000, based on a similar indicator. When we came down in 2023, all that we did was retest the top of the tech bubble level, and here we are back up again at the 2021, high valuations. I still contend this is a large cap bubble that we're in, and I believe it's ready to roll over. Let's go on to the next. So what are some of the other indicators that this is ready to roll over? Well, cash levels. Look at how this is the BofA Fund Manager survey. Look at how money manager cash levels are as low as they've been since that late 2021 market top. And other than that, it's the lowest they've been in 10 years. Go on to the next. Positioning. Here's looking at futures, equity futures positioning by asset managers. It's above 2 standard deviations in terms of net long positioning in U.S. equity futures that they've ever been. So these are contrarian indicators. When cash is too low, where's that cash to come in and buy more? You're much more likely to have to sell if the fundamentals start to turn down. And so same thing with positioning on the future side. Let's go on to the next. Here's short interest on the SPYs and the Qs. As relative to shares outstanding, short interest is the lowest it's ever been. People are afraid to be short the large cap indices. Let's go on to the next. These are contrarian indicators. So as you know, we have a big long theme on the precious metal side, including electrification metals as well. This is looking at the Barron's Gold Mining Index to gold ratio. And so what's the Barron's Gold Mining Index? So Barron's, going all the way back to like the 1930s, used to publish used to publish industry indices all the way up until like 1980, and maybe even the late 80s. And somebody purchased a license to their database and has continued that series, and it's called Gold. The guy's, his name is Nick or something like that, and he runs an outfit called Gold Charts Are Us, GCRU. Look it up if you want to get the data. It's actually pretty cheap. But the reason it's important is this Barron's Gold Mining Index. It goes all the way back to the 1930s, and you can look at the gold stock index back to the 1930s. It's incredible data. And look how cheap gold stocks are. And so this guy Nick has continued the series to this day, and you can't find the data on Bloomberg, or you have to go to him directly to get it. But look, we are gold stocks are the cheapest effectively that they've been relative to gold itself. Since the 1960s, before that huge run up that we had in the 1970s. Let's go on to the next. Similarly, we're focused here at Crescat on exploration stocks, and similarly to that larger cap Barron's Gold Mining Index relative to gold, there's a junior mining index that we use, and it's actually a proxy for junior miners. That's the TSXV composite, and it's a proxy for junior miners because it's something like 67% of the companies that are in this index are junior mining stocks, and it's the TSXV index, and the TSXV exchange. There's actually a couple thousand stocks that are listed on the TSXV exchange, 1,900 companies to be precise, and 51% of those are mining stocks, so junior mining stocks. There's like 120 some companies in this TSXV composite index. 60+% of them are mining stocks. And the average market cap is a couple $100 million. And in this bigger index, you have to be in the top 0.2% of the broader exchange, this TSXV exchange, to be in the index. That's the criteria. If you look at the average market cap of the mining stocks that are in the bigger TSXV composite, it's like $29 million US average market cap. So I mean, this is our universe of public explorers. There's also junior mining companies listed on the Australian exchange and other exchanges like the Canadian Securities Exchange. But TSXV, the venture, is really the proxy that we can use. And so what do we see when we look at the TSX Venture Exchange Index? I mean, gold has been hitting new all-time highs. This index hit its prior high in US dollar terms of 3,400 plus in 2007. And I can't, you have to do your own math in your head to see, how many times higher it is compared to the $412 per share that it's trading today. But hint, it's something like 7 times. But look at where gold is hitting new all-time highs. Look at how depressed the exploration stocks are relative to their prior highs. This is similar to that Barron's chart that we're showing. We're just focused more on the junior explorers. The value opportunity in junior mining companies today is extraordinary. But there's a lot of companies. One really needs, we think, expert guidance in order to know which ones to focus on, and that's what we're about with Quentin's expertise. I think that's all that I have. Let's make sure, Nathaniel. Yep. So on to Tavi.
All right. Well, Thanks, Kevin. Let me start with a phrase I've been thinking a lot about. Markets often defy conventional wisdom. And the idea of this presentation this week is to talk a little bit about that and some of those thoughts that we've had in markets over the last, especially coming from investors over the last years and decades that have essentially not turned out to be great calls. And usually the most this is why investors shouldn't be contrarian for a contrarian sake, but instead looking for enough macro and value reasons to be taking that very different opinion relative to what conventional wisdom is. One of them would be the gold market. Who would have thought that gold would rise with interest rates rising? I mean, I would say that 2-3 years ago, that would have been unthinkable. And a lot of people challenge the thought of gold markets moving higher because of the risk of interest rates. That's certainly has been one of them. And there are many others that kind of fall into this picture. And usually you have a few sectors that tend to lead the market on one cycle that then in the next cycle are actually the ones that tend to lag, or at least not lead. And the laggers of the prior cycle are usually the ones that could be the ones that potentially lead. So it's called the rotation that we tend to see across sectors over time. That rotation is real. It often happens after 5-10 years. And usually it's caused by success. You have the success of a business model in a certain cycle that attracts capital, inflates valuations, and then smart investors get out of the position after they made a lot of money. And then those that are late to the party end up holding the bag, and then we see a crash in markets. And then the market starts over again with the leadership that changes over with new sectors that will be leading the way. So let's go to one chart that is interesting. If we go, there you go. And you can see here, one very conventional thought not too long ago was that China was going to take over the world, that the Chinese yuan or the Chinese currency was going to become the reserve currency. And Kevin and I used to write a lot about the Chinese economy. And instead, even from a market cap perspective, the idea was that China was closer to becoming this new power rather than the other way around. Instead, we've seen sort of an implosion of their own economy through many reasons that we actually express our opinions back in the days and actually made money on in our portfolios, which was related to the real estate bubble and the overly, the over infrastructure developments that we've seen over the years in China, the banking crisis. And one thing that is still hanging in there that we think it could happen is the Chinese currency devaluation. But you can see here that from a total market cap to global equity markets basis, you can see that the U.S. is now about 47% of the global economy. That is, probably, unfortunately, this chart doesn't go back even further, but I would suspect that this is probably the highest, probably close to what we saw back in the tech bubble as well. We know that most of the companies in the U.S. are very international. That's why I like to look at that relative to overall market cap. And you can see here, by the way, there are other emerging markets like Brazil that don't even have a digit in front of it because it's basically less than 1% of the market cap of the global equity market. And those are the ones that are, to me, present an even better opportunity. So let's go to the next chart. Now, if we looked at, Warren Buffett's favorite indicator for valuation, which is market cap to GDP, and we take a step back and also add equity risk premium, which I think it's a very important way to measure valuation, or I should say, just how much you're paying for the potential premium of a certain equity market. In this case, it includes the earnings yield of a market for each of those countries in the screen, but also it takes into consideration the cost of debt, meaning the interest rate environment that those countries are in. And you can see here clearly that the U.S. is by far the most expensive market in global equity markets today, from a market cap to GDP perspective, but also for how low the equity risk premium is in the U.S. as well. You can see other opportunities. Some of them are maybe we should call uninvestable or more difficult to deploy capital into. Turkey, Russia, those offer very low market cap to GDP levels with actually very high equity risk premium. And then you have the more, I guess, easier ways of expressing your view in markets, which is, in our opinion, would be South America. You can find a lot of those countries in the bucket in the far bottom left would be Brazil. You can see Chile, you can see Mexico, you can see Peru. All those countries actually fall into that bucket. Some of them have lower market cap to GDP, still have low equity risk premium, and some others like Brazil would be more balanced, or Chile would be more balanced. That look attractive in both sides. And you have some other outliers like South Korea that don't have as much of a high market cap to GDP, but also a very high equity risk premium. And so you can see where sort of the, I hate to use a Jim Cramer quote, but there's always a bull market somewhere. And that in this chart, you can sort of look for those, and you got to dig in further to see what the opportunities are. But certainly you can see here, there are things that are really cheap out there and very undervalued. Most of them have a reason for it. But this whole concept of buying something low and selling something high, it's much easier said than done. It requires a sort of psychological, comfort to be able to buy something that is against the crowds. And I think that it would be unthinkable to see perhaps the leadership of the U.S. Falling away from other economies, in which I think this is very high, actually highly likely, particularly coming from emerging markets with resource-rich economies. And I think this chart is just another supporting evidence of how potentially we could see that shift of leadership. And even from a prior chart, you can even maybe see that market cap to global market cap from the U.S. to reduce drastically over the years, mostly driven by not only a potential decline that Kevin was referring to, but really as well through the rise of other economies that could do much better in this environment. Let's go to the next chart. And you can see here another unthinkable, and funny enough, we do a macro meeting every Tuesday in which we had this chart, and Quentin doesn't usually participate on those because he's busy with his other things, but he also sent this chart to us, and I thought it was interesting because we had the same idea. But you can see here in the 70s is basically looking at a stagflationary era, and you can see correlations of assets. It's a really good way to sort of pick and choose asset classes that perform well or didn't during the 1970s period. And you can see clearly that gold not only performed well throughout the whole decade, but was consistently a good annual performing asset class during that period. You can also see commodities did very well in green, following gold in many ways. And I would say that the other part of it that is interesting is if you look at the bottoms of this chart, there are many times in history where technology companies showed up as a part of the market. And by the way, technology companies were not truly as frothy as they are today in terms of valuations. Therefore, one can make the case that coming up from much higher prices, as Kevin was alluding to here in his presentation, that maybe the compression of multiples could be even more severe in the days like today. So let's go to the next chart, and I think this is kind of ties with this idea that I think a lot of people have sort of acknowledged that we're living in this new era, of interest rates being higher for longer. I think most people would agree with that thesis, but the markets, parts of the markets are behaving that way and other parts aren't. And I'll explain a few of those. The ones that are participating in that new era world is gold, actually performing better than treasuries. You're seeing sell-offs of treasuries with gold rising. Well, that's a unique environment that we tend to see during stagflationary eras. You can also look at how some of the value companies that we haven't seen perform well in a very long time, like energy companies, is starting to take the lead in the last 2 years or so, or not the prior year, but 2021 and 2022. Energy had such a strong performance, and that was very unusual for the type of market of a disinflationary environment that we've been in for so long. We're seeing other commodities taking charge, that sort of rotation of commodity prices, where you tend to see, now it's cocoa, but used to be orange juice, and at some point, not too long ago was gold, making new highs, and those things keep rotating. And we had the silver squeeze, and now silver is my view poised to do that again. You have copper now, so you can see that there's a rotation happening, and then you have others like natural gas prices, which I will touch on this here in a minute, basically trading at historical low levels. And so, but those things keep moving, and you can see that that's really this new era of higher interest rates, but also higher inflation moving forward. But then when I think about that, and I look at, if we're going to see a world of higher interest rates where, think about a company that has a junk rating. A company that has a junk rating, back 5-7 years ago, we used to borrow money at about 4 to 5% interest rate. That was a great environment. That was the ZERP environment, the near zero interest rate policies that we've had across the globe for many years, that really helped those junk rated companies to be able to borrow money for nothing and continue to run businesses that are very, not profitable. Now, in this environment of high interest rates, if you just look in nominal terms, you can see clearly that interest rates for junk bonds are now at around 8-9%. That's an average, right? And if most companies, some other companies are actually having to borrow capital at around 10, 12, so double digits today. And if you think about in that environment, how in the world have we repriced the cost of debt, but have we not repriced the risk of default? Because just logically, if a company is borrowing money and interest rates are rising for a while, 2 to 3 years of a rise of interest rates. I mean, look at this chart. The red line has been rising steadily for the last 3 years at least. If you consider that as something that is, maybe moving forward, we'll continue to see that. How have we not seen the same impact in other things like credit risk? And so now you're looking at the other line there, which is looking at the credit spreads, which if we go to the next chart, you can see credit spreads today. And you can look at this in many different ways. You can look at different spreads. In this case, I'm looking at the corporate BAA versus the 10-year yield. And so what does that mean? It's basically you're looking at the spread between a bond from a corporation relative to a risk-free government security. And you can, so basically spreads are less than 2%. It's about 1.5%. So you're basically, in order to buy that corporate bond, you're assuming that there's basically no risk essentially relative to risk-free rates or the U.S. government securities in a world like today. Now, this may sound unique, and it is because it's one of the lowest levels we've seen in history. But if you notice in the first panel of this chart, and I showed where other periods where we saw this period of suppression of credit risk itself, you can see that actually that tends to coincide with periods when the Fed is hiking interest rates. And so the Fed starts hiking interest rates. That causes interest rates of risk-free rates to increase, right? And then that ends up causing a suppression of credit risk priced in the markets that essentially at some point creates some sort of issue, which in each of those arrows that I have there had different things that caused those problems. One of them was the global financial crisis or the tech bust, and others. And eventually it causes the spread to really widen. And so you see investors are starting to price that risk, increase drastically. Now, if you ask me, if we're living in this new era of inflation staying higher for longer, structural problems with consumer prices being higher because of deglobalization, the labor markets, you can talk about the fiscal spending, all sorts of things creating this. And the prior chart, if you look at that red line, if that is the right trend that we should be watching for, then I believe that this chart right there is massively mispriced. And or essentially, if I'm wrong, then it means that we're going back to a disinflationary world. My view. I don't think that that's really what's going to unfold in the next decade. I think what's likely to unfold is that inflation will be sticky, interest rates are going to be higher for longer, inflation will be higher for longer, and the risk of default is going to have to be priced more appropriately, which is not at a 30-year low. And so that means Crescat is short junk bonds. That's one way to think about it. Let's go to the next chart. And so think, now if you consider a little bit more about this idea of cost of capital, and cost of capital, you can break it down in two ways. It's not just interest rates. Interest rates is one measurement, but dividends is another one. We saw Google was very small, but Google actually announced a dividend yesterday on their earnings release. We've had a few airline companies, and I always joke about this, but if you're in a higher cost of capital environment, when airlines, one of the worst margin businesses in the world, are starting to pay dividends, that means they're being pressured by investors to actually start, even the miners. I mean, we're even seeing the miners paying dividends in a degree that we haven't seen before. That is, again, pressure from not only competition of other bonds and other instruments out there that are yielding something, and in order to attract capital, those companies need to start either paying dividends or doing buybacks. And so, interestingly, if you look at throughout history, dividends during inflationary eras basically, made up close to over, in the 40s was 67, in the 1970s was 73% of the overall return in equity markets came from dividends. And so are we entering an era that will look like that? I think so. I think that's going to be highly likely, especially because overall return from equity markets are going to be highly unlikely to be the same, high growth that we've seen in returns especially over the last year. So I think that's highly unlikely in this next decade. And so growth may actually come from things like dividends. And you can see the NA there on 2000s because it's because the return was negative. And so the dividends was 100% dividend. It wasn't an inflationary era. It was really because we saw the opposite of an inflationary era, but not because companies are paying dividends, as you can see. It was really because the decline of the actual returns of financial markets. But let's go to the next chart. So now, this is a good picture of yield curve inversion going back all the way to 1920s. I like this chart for many reasons. Number one, it reminds me of the scenario that we study, quite a lot here at Crescat, which is 1973-74, during the stagflationary environment, where we've had commodities actually do very well on the back of equity markets declining. But we've also had a period where there was a steepening of the yield curve. And you can see here that every time the yield curve was basically deeply inverted, we've had an aggressive movement to the upside. And if you ask me, I think that we're getting either close or in the process of that movement on the upside. In fact, if you go to the next chart, you can see in a closer look of 2 to 3 years, you can see that the 2 versus 10-year yields, 30-year yields are starting to move to the upside. And I think this is just the beginning. I think it will accelerate as we see this moving forward. Now, more importantly is the fact that an inverting process of a yield curve also coincides with a recession, is also a recessionary indicator for the economy that we should be watching for, and knowing that we've went from whatever 7 cuts priced in the Fed funds rate to now almost no cuts for the year. I guess 1 cut in December, in November. To me it seems a little complacent. The potential risk, especially coming from those signals that we have in credit markets that, by the way, never failed before, all the way to the 1920s, never failed before. And then on top of it, I just pointed out the whole point about credit spreads, how the risk is mispriced. And as we see that moving, I believe that that's also going to be aligned with the steepening of the yield curve too. Let's go to the next chart. And you can see here, interestingly, the correlation between the markets now. So if you look at there's 2 types of S&P 500, or there's more, but if we just look at the 2 types here, market cap weighted versus equal weighted, and you can see clearly that the correlation between the 2 are one of the lowest that we've seen in history. Now, if you look back, essentially, all the time we have this, the breakdown, or I should say a leadership that is composed mostly by the mega cap companies, which is the case with market cap more driven index. And you see the equal weighted. I mean, just take a look at the Russell 2000 for the last 2 to 3 years. It is a complete different picture of the NASDAQ. In fact, that is down year to date already. And also, I should point out, for the last 2 years, it's gone, basically down relative to NASDAQ going up so much. And so when you see that rolling correlation declining significantly in this case and becoming weaker, I would say that that's usually aligned with some sort of issue, and that's because of this the breadth of the market is starting to show some levels of weakness. And so this is another sort of indicator to see that things are not as healthy as they may look like. Let's go to the next chart. Another correlation that I often talk about is this correlation between S&P 500 and treasuries. And, I talk about this new era environment, the new era of interest rates being higher. Well, what that changes is also the correlation between these 2 asset classes that are probably one of the most important ones out there, because most traditional investors are allocating capital every day into these 2 asset classes because they hold what's called the 60-40 portfolio, 60% equities, 40% fixed income. And so, but the interesting part about this chart is that you can see that this correlation was also positive back in the 1970s. And we went through a period here that we call the golden era of 60-40 portfolios that we think is ending. But if you go even step backwards and look even further in history, let's go to the next chart. You can see Bank of America did this chart going back all the way to 1945. And shame on me, I should have done that chart too. But you can see here clearly that this is the new era, really, or I should say the outlier really was the prior decades. I mean, it's normal to see bonds and equities having a very strong positive correlation throughout history. And so are we back to that normal era that we've had in the past? And I do think that's the case. As we see the cost of capital, and people are ignoring this, cost of capital continues to, establish itself higher and higher. And again, not only we're not discounting companies properly, I think, because if your discounting rate is getting higher, then your present value of the business that is having all these future free cash flows should be lower, right? But for whatever reason, euphoric, speculative environment, call it whatever you want to call it, we're not seeing that yet. But ultimately, markets will come to gravity works at some point, and you start seeing we'll go back to a more of a rational environment. And so we're probably going to go back to a place where bonds and stocks are moving together, and also a place where those correlations will also cause investors to change how they allocate their own traditional portfolios. And so this is why we've been big proponents of this shift away from 60-40 allocations and considering other things that can be very attractive. I remember not too long ago, everybody used to say, you just got to buy T-bills and chill. Why even buy anything else that doesn't yield anything? Well, that was exactly the time when gold just had a massive movement on the upside and made everybody who was holding those T-bills for whatever 4 to 5% yield, not look as smart. And so that's what markets do to you. It's just, the certain things are usually wrong. So let's go to the next chart. Okay, so what's happening in Japan in line with all this is also really relevant. So we're seeing on the, Japan is an economy which I think China is going to go through what Japan is going through. But you can see here clearly in this chart that Japan is going, it's a very different environment Japan has faced over the last 20 to 30 years. Inflation expectations, which is driven by the markets, you can see in white, are rising at the same time the Japanese yen is devaluing. Now, you can say, well, this is very pronounced in Japan, but is it really just Japan? No, it's a global phenomenon. We're seeing this rise of inflation expectations with central banks not being able to tight monetary conditions as they wish. And so they're letting their currency go. And so therefore, we're seeing this global fiat debasement happening. And it's what's causing as well commodities to rise. So this is a phenomenon we should all be using as a model for what's likely to happen here in the U.S. By the way, if you look at the BOJ assets today, it's about 130% of relative to market cap to GDP in Japan. The U.S. is close to 30%. It's actually lower than 30%, about 25 to 30%. So if that's a roadmap for the U.S., boy, we've got a long way to go here. There's multiples that we got to change here in terms of how much the Fed assets need to change relative to GDP in the U.S. Obviously, we know that also Japan carries a much higher leverage today in their economy relative to their GDP. But I think we're probably going to the same direction. I don't see that reversing anytime soon. Let's go to the next chart. Okay, so what's happening now as well in line with this inflationary thesis is that you can see that global house prices have begun to rebound in a lot of places. You can see Australia now, it's up 9%. You have US, you have New Zealand, Sweden, Canada is still lower, but all of them are starting to rebound on a year-over-year basis. Well, I think central banks will be looking at it. And it's funny enough that Europe or the ECB is starting to talk about already very seriously about cutting interest rates, changing their tune in a large way. The only one moving in a different direction has been the BOJ, but the BOJ is ahead of the curve, and they're just basically facing a currency crisis, and therefore why they're having to move. But this is a problem. Again, it's a global phenomenon, and it's important to see that when house prices begin to rise again, because house prices are another form of hard assets too. So it's important to pay attention to that too. Let's go to the next chart. Now, one, I think, opportunity that the market is presenting to us, again, it's easy to talk about buy low and sell high, but here is one way to think about buy low and sell high. Natural gas prices are hitting, retesting levels that we've seen in the prior 7 major bottoms of this commodity. And now I can come up with a few reasons why natural gas should continue to move lower. But from a risk-reward perspective, this is looking really attractive. So we made a position. We're long natural gas prices at Crescat on the global macro fund. Let's go to the next chart. And you can see here, those are the changes that we've seen in the past of natural gas prices and this sort of performance we've had when we hit those lows in the past. And you can see some crazy numbers there. And I'm not saying we're going to see those numbers. I just think it's important to look back in history and see that this is a very volatile commodity and it for a reason as well. But also I think it's presenting an opportunity for investors that understand that level of volatility too. Let's go to the next chart. And one thing that is important was Toby Rice, which is the EQT, one of the largest natural gas producers in the U.S., was talking on CNBC the other day. And he was basically saying how this AI demand that is likely to drive electricity consumption and so forth is also likely to drive the demand for natural gas. According to him, well, we all know the LNG idea, right? This divergence between global prices of natural gas versus natural gas prices in the U.S. It's a huge gap. And the main reason for that is because our LNG ports, and also when those are functioning the right way and we're actually sending LNG through, to the world, we're probably going to see those prices converge at some point. Now, for many reasons, we haven't seen that price convergence just yet. Now, just from that perspective, you would probably increase the demand for natural gas by about 15 BCF per day. That's what, according to Toby Rice. I'm literally paraphrasing what he said. The second thing he talked about, which I thought was even more interesting, is this AI revolution is likely to increase the electricity consumption by something equivalent to 15 New York cities. It's crazy. And according to him, that would be very similar demand for natural gas that would actually increase from the LNG construction and so forth to converge the prices, which would be another 15 BCF per day as well. So those are two things to pay attention to. Next, go to the next chart. And it all kind of falls into this idea of the infrastructure spending that we're seeing. Infrastructure spending caused by the reshoring, deglobalization. We've had this chart just showing you how much we have passed in our acts that have been passed already by the government in order to be spent. And it's close to $1.7 trillion, which is completely dwarfs what we saw, coming out of the World War II in terms of the rebuilding globally, not just in the U.S., globally. It's about 3 times. This is all inflation adjusted before somebody tries to murder me. It's all inflation adjusted numbers. It's kind of, it blows my mind. There's a reason why commodities and metal prices are moving higher. And it's crazy to me, when you go to the next chart, conventional wisdom still thinks that the miners won't make money. When you think about how the miners move, well, fundamentals matter. And you can see clearly in this chart, free cash flows and prices of the miners. It's the same chart. I mean, if you just really have to understand the fundamentals are going to improve or not in this environment where gold prices are trading today, copper prices, zinc prices, silver prices, and which we think are going to be trading even higher. What does that do to those margins that we're seeing today? It's not like the cost structure of those companies are, rising the same pace of the metal price in the last, call it 6 months or so. So I believe that in this case, the white line of this chart is poised to continue to move up, and that's going to cause the demand for the blue line, the prices to move higher as well. Let's go to the next chart. And go back to that idea of how markets tend to defy conventional wisdom. What is a conventional wisdom about the miners? Oh, the miners are terrible investments. I don't want to touch it. I like gold, but I don't want to touch the miners. I don't know an industry that's more hated than the junior mining industry. And then I looked at the mining stocks relative to gold, and they certainly have underperformed over the last 30 years or so. But they're so close to, for me, a historical bottom here. I think they're much closer than people think. And this chart actually might become very meaningful as we see, as I was presenting the idea of new sectors, new industries leading the way to the upside. I think this has a very strong potential of being one of them. Let's go to the next chart. And so one example of this is just looking at the relevance of the gold market in prior eras, 1920s, 1930s, 1940s, 1980s. And you can see today, the gold market is very small relative to equity markets, bond markets, real estate, and so forth. And so, I would suspect that in a world where we've seen so much expansion of money supply and liquidity, ultimately drives hard assets higher, and gold is a big driver of that. And I think gold is going to be representing a much larger percentage of global assets as a whole in the future. And that ultimately should also flow into the miners as they present, in my view, the most asymmetric opportunity across all these things. Let's go to the next chart. I'm almost done. The last thing I want to talk about is something I pointed out not too long ago. And, we had an interview with Kitco the other day, and something I said, and I want to say it again. If I die tomorrow or tonight, if I had one thing that I wish people would understand from me, at least that I learned that I would pass it on, is that anybody can borrow someone's conviction, but or I should say, anybody can borrow someone's thesis, but nobody can borrow your conviction. That's a big difference. Why? Because every thesis will be tested at some point. Here's the Brazilian market. It broke out from a historic support, should call it resistance. It looks like it's off, to a bull market. And guess what? It's now retesting that line again. Now, a lot of people have probably borrowed that idea, but the conviction comes here. because now we're retesting that level. Is the same thing happened with the miners over the last 3 years. That conviction, no one can borrow from you. It's just, and that's what makes the difference of an investor that is opportunistic when prices decline and things get cheaper and you accumulate more. So to me, this is another one of those. I presented a thesis for Brazilian equity markets before many times. And to me, this is another opportunity. The sell-off that we've had recently is just, to me, is an opportunity for investors that have that mindset of long-term to reposition and accumulate more of those supposedly undervalued, historically undervalued shares, in my opinion. All right, I think this is my last chart. So, yep, Quentin, take it away from here.
All right, thanks, Tommy. Look, while you were talking there, I was doing a little examining. I just wanted to, put it in perspective about how much gold has moved over the past, say, 5 years, since COVID came around, to compared to the Dow and the S&P and the Nasdaq. And I actually, it's surprising. I mean, the Nasdaq's up 110% or thereabouts, but gold's now up 80 odd percent. I think it was 89% before I shut the window. It's ahead of the Dow, and I think it's neck and neck with the S&P. Just think, over the next year or two, looking back, I think we're going to see gold's going to outpace all of them. And that actually happened from 2001 to, 2012. If you remember, gold went from a piddly little $252 an ounce, I think January 2001, and it went all the way up to 1900 in September of 2011. So people think, that's crazy talk, whatever. It ain't crazy talk. It's happened before, and we're kind of seeing it happen, the start of it, at least right now. Anyway, this week I'm going to talk about what I see as a gigantic game of musical chairs in the mining industry. If you've ever played musical chairs, you know that every time there's a poor kid that didn't find their seat when the music stops, that kid gets out, but they also take one of the chairs away. In other words, the number of kids and the number of chairs dwindles down to the last person standing. And I kind of see the mining industry in this light lately. We're looking at consolidations here lately. Like look at Newmont taking over Newcrest, and then this week, finding out BHP's made an offer for Anglo-American. I mean, these are big deals. These are not little scale deals. These are at the very top end of the spectrum in terms of mining companies. And as we see this consolidation happen, the number of players is going down. I'm not saying the deal's done by any stretch yet. We'll talk more about that in a minute, but it is a worry. It feels like the chairs are diminishing, and we need to see more smaller mining companies kind of step in and start to fill this vacuum. My best guess is it's going to have to happen on the back of a super commodity bull that's coming. We have been so constrained on the supply side now for years and years. The capital has not been available for this space, but it's going to have to turn. It has to. Until we see that, I think we're going to see fewer and fewer chairs. Now, let's talk about this announcement between BHP and Anglo this week. Go to the next slide. It was promptly shot down by Anglo-American, rejecting the bid. Are they posturing? Yeah, probably a bit. There's definitely room for added value. I think it was an opportunistic bid, but that's what BHP's job is supposed to be. Mike Henry is supposed to get value for his shareholders. So, is the game over? No, I don't think so. But you did see some activist investors take positions today. Why? Because there's probably more to this story. Okay. But what I want to focus on, and I want to focus everybody's attention on that's listening to the video here, is what is this all about? Okay. Why Anglo-American? So let's do a little digging. Go to the next slide. Here's a clip straight from Wikipedia. These are the stats about Anglo-American. It was started in 1917. Think back to that period. I mean, that's almost a little over 100 years ago. But it was actually at the same time thereabouts that other big companies were starting, mining companies in particular, starting around the world. Newmont got its start in 1921. in that same era. Anyway, there was a period where there was this kind of golden age of where a lot of major mining companies got their foundation in and around the World War I era. Okay, and that's where Anglo-American started. They started with the huge and highly rich deposits of South Africa, not just gold but other metals. Look, I'm not going to go into the full details here, but it was started by Oppenheimer. Ernest Oppenheimer started the company, visionary. They ended up taking out De Beers, which was started by Cecil Rhodes, by the way. So we're talking about legendary mining people that are behind the formation of Anglo-American and its subsidiaries. Where is it today? Well, it's been struggling. Okay, really since COVID, it's had a number of missteps that have decreased its value, but made it a desirable takeover target by folks like BHP. Okay, so let's talk about what Anglo-American mines. Okay, go to the next slide. So this is straight off of their website. This basically shows the commodities that Anglo-American is mining. They're producing, and copper is in the upper left there, but you got nickel, platinum group metals, and that's all of the platinum group metals. It still has the mines in South Africa and a few elsewhere. It's also got diamonds, through that De Beers subsidiary. It's got some iron ore, not anywhere near, say, BHP or Rio Tinto or Vale or something like that, but it does have a pretty large iron ore business. It also makes or produces steelmaking coal, so coking coal, manganese. A lot of people don't even know what manganese, but it's a very important ferrometal that's used for alloying, but also now recently batteries and things like that. And then polyhalite and things like this for agriculture, for fertilizer and stuff. Now, of all of those metals that you see, or all those commodities that you see there, what do you think BHP is going after, guys? I mean, it's very simple. The copper. Okay, the one in the upper left. Copper is the focus. I don't think BHP is all that interested. Well, maybe they're interested in the nickel. That could complement some of BHP's nickel. But the diamonds, probably not. Iron ore, maybe, yeah, kind of. I don't know. The BHP has the best iron ore mines in the world, so it's hard to imagine these would, outshine the ones they already have. It's about copper, guys. Okay, copper. Let's go to the next slide. All right, so copper is going to dominate, in my view, dominate this commodity cycle. I think it's going to outshine all other metals. Okay. I'm a gold guy, or I have been traditionally my entire career. So it's a bit painful to say we're abdicating, this prestige to a bit of a pinkish metal, kind of a sissy looking metal, really. No, I'm teasing. But it is very important for the future. It's very important for electrification. I think Tavi talked a bit about, the need for more and more power as AI comes on and things like this. Copper is where it's at. Okay, supply side has been constrained. We haven't seen as many copper mines come online as we need to provide the copper that the world is going to need over the next few decades. All right, let's go to the next slide. So what does this mean in terms of the playing field, like mining and mergers and acquisitions and stuff like this? Well, this comes from Mining Visuals. This is copper production by company in 2023. I had to make one edit to this slide because Newmont combined with Newcrest, which happened, I think, right around the end of the year. Those two companies combined produce almost 200,000 tons of copper. So that would actually put them on the list slightly ahead of Barrick. But you can see here a list of all of the top copper producers. And Freeport is the top dog at the moment. Okay, they are definitely the top dog, but BHP is a close second. And then you can see down the list there, what is it, about 6 or 7, I think, spaces, there's Anglo-American. That's why BHP wants it. If they pull in that copper production, they will dominate the copper production space. They'll be quite a ways ahead of Freeport. Okay, it would just basically cause BHP to leapfrog to the head of the pack. And BHP is not accustomed to being second at anything. Okay, just bear that in mind. All right, so this is a big prize for them, but there are a lot of copper players. Do you think Freeport's going to sit on their keister and let something like this happen? Yeah, probably not. Okay, there's other companies that are very competitive here. Codelco has seen diminishing copper production. They need to find more. Okay, Glencore very, very aggressive. In pursuing acquisitions. But there's a whole bunch in this space that are, we'll say, either candidates to take over other companies or are potential takeover targets. All right. And I would say that we have to now we have to expand our spectrum. I'll put 2 yellow stars on here and say that even the gold players, the biggest gold players at least, are also competing in this space. Barrick and Newmont. I mean, as crazy as that sounds, I think most of their focus is going to be on copper, looking at copper, maybe copper gold assets, but they are going to be focused on acquisitions in the copper space. Now, it also could be that some of these bigger companies up there might look at a little company like Barrick or Newmont and say, maybe we take them out. Okay. So interesting dynamics are going to come into play here. All right. The copper and the gold industries are going to they're going to come to a juncture here. And I think the whole M&A space in the mining world is going to shift dramatically, but the center of gravity is going to be copper. All right, go to the next slide. I got to put skates on here. Now, I think with the current deal that we see with BHP making their offer, is either going to be trumped or attempted to be trumped by a white knight. Like I said, there's a lot of players out there who aren't going to put up with being displaced, like Freeport. Okay, but the other possibility, and this is a very likely possibility in my view, is that Anglo-American might get carved up like a big turkey. Okay, you might see their copper go to BHP or something like this, and then other units or production units maybe go to other companies. It's just carved up and put into tucked into other companies. All right, but something's going to happen. The kind of convergence we saw with Glencore and Teck last year, that was an indication something was up. But now we're going to see we see the big boys coming to the table. Big things are coming. Go to the next slide. Okay, just a week ago, believe it or not, just a week ago, I showed this slide. I showed how copper has broken out. It's a 5-year atomic wedgie, but it's broken out and it's moving up pretty quick. It's not just a straight line, but it's up to around $4.50 a pound at this time. Okay, that's the highest it's been for quite some time. But it also has that momentum, I think, that we haven't seen in the metal space for quite a few years now. It's really got some legs to it. And we do have a number of copper investments. I touched on some of these over here on the left last week, but this week I want to talk about 2 that we have that aren't on that list. Okay, those that are listed there are companies that I have spoken about on videos over the past few years. And many of you guys who watch this are aware of those already, but I'm going to present 2 new ones. Okay, now one of them is private and one of them is public. Okay, so I told you we're starting to get our skates on and put money to work into new companies. Okay, so let's go to the next slide. Okay, this is the private one. I'm going to talk about the private investment we have. This Jex Technologies is a privately held company. Shareholders like us and many other funds and such have positions in this company, and it is not it's not a mining company in the strict sense. Okay, this is not a company that operates mines or has mining projects or exploration projects or whatever. This is something totally different, and quite frankly, it's somewhat unique in our portfolio. This is a company that has a technology that I feel very strongly could totally revolutionize the copper industry and the gold industry, and maybe even a few other industries, a few other metals. Okay, this isn't a little story. This is a really big story. And I'm going to walk you through it really quick, but I want to give you an impression of the opportunity and the reason why you need to consider Crescat, us, because we see these opportunities, whereas most people aren't even aware of them. Okay. All right, go to the next slide. I did throw the forward-looking statement slide in here because I grabbed these slides. The company actually provided these to me, and I want to make sure that people are aware this is an early stage company, but it is, and there's some things in their slides that require forward-looking statement, but it is a very exciting opportunity. All right, let's go to the next slide. Okay, who runs the company? Dave McMullen. Okay, I met Dave a couple of years ago. He happens to be involved with another investment we had. And through that convergence of meeting Dave through that, I learned about JEX. And I also met with some of these other folks on here, George Young, for example, Vincent Spinelli. Look, very sharp team of people. They're mainly in the realm of metallurgy and engineering, so they're not traditional explorers or things like that, like I usually present. But these guys are super smart, and they're very, very capable of running a highly technical company like JEX. Okay, go to the next slide. And by the way, if anybody in the audience ever wants to reach out to the company, Dave is the man to speak with. Okay, what is JEX Technologies? Well, they have this process, this right to a technique, you will call it a patent, called HydroJEX. And it is basically a means of extracting metal from rock that we thought was already done. Like we thought we had extracted the metal. Any residual metal, this process can scavenge it. Okay, and this was invented by Dr. Tom Seal. He was at Newmont. In fact, that's why I, it's like when Dave said, "Oh, Tom Seal's, invented this, or basically has a patent on this." I was like, holy cow. Okay, this Tom Seal is an old timer at Newmont, but he was a senior metallurgist at the company, and the guy knows his stuff, and he's very, very creative. In fact, Newmont has a long tradition of having very creative metallurgists working for them. So when I saw this, I was like, yep, I'm in. Okay, no matter what. All right, go to the next slide. Okay, the investment thesis. Look, I could go through each one of these bullets, but to sum it up is this: it's a patented technology, and it's a very broad patent. In other words, they have a patent over the process in a big way, so that other companies cannot directly compete with them. I checked into that, make sure we weren't talking about something that was going to be, just leapfrogged by some other company out there with some other competing technology. They have the goods. And I'm very confident nobody else can displace them or displace the market that they are going to attempt to capture here. Okay, they are already working with some of the biggest mining companies in the world. In fact, Anglo-American is one of their customers. Just so happens, though, they did a deal with Freeport here recently, and I'm going to take a little bit of credit because I was the one that introduced the company to Richard Atkerson and Kathleen. About a year ago. I think it was a year ago today-ish, more or less. I happened to have a beer with Richard and Kathleen after a function, and I told them about JEX. And I'm telling you, within 48 hours, half of the vice presidents of Freeport were on a phone call with JEX, and they were all over this thing. It was, I've never seen people jump on something that fast. Okay, and they've now taken a 10.7% position. More importantly, they are aggressively using or utilizing this process, this technique, for many of their old heap leach operations, starting with Morenci down in Arizona. Go to the next slide. Okay, so what does this do? Well, this is a picture, a cross-sectional view of a heap leach, a schematic image, if you will, and it shows how we tend to stack a heap. It's usually stacked in layers. This is just broken up rock or crushed rock that's stacked. And then we put a sprinkler system over the top of these layers so that the fluids coming out of the sprinkler system trickle down through the stack of rock. And they basically dissolve metal. They have chemicals in the solutions that dissolve metal. They go down to the bottom, go off to the solution reservoir, and then the metals, the fluids are pumped out and metals are stripped out of the solution. Pretty simple process, but there's some problems that develop. Mainly channelization. Okay, if you see the blue lines, those represent pathways for the fluids. And oftentimes the fluid that's put on a heap gets channelized and it only goes down in certain paths. And it has trouble spreading out into the rock adjoining the pathways that have formed. Okay, so there's a lot of dry pockets. There's also things like clandestine matter, meaning things like in the gold world, maybe carbonaceous material or something you want to avoid. Okay, that's also a problem in heap leach. But this shows you that a heap is very ineffective in many ways. I'm not saying it's totally ineffective. We use heap leaching for years, but it's very ineffective in terms of its gross metal recovery. You leave a lot of metal in a heap leach because of those problems right there. Go to the next slide. Okay, so what are we talking about doing? Okay, this is a picture of one of their Hydrodex units. It's basically a machine with pumps and whatnot, and I'm a geologist, and I don't dare go into this space because I'm not an engineer. But it basically uses a pressurized system of injecting fluids into a heap leach such that the fluids can scavenge metal from all those dry areas. Okay, the company usually goes in and does a little bit of shallow level geophysical work over an old heap leach to ascertain where the dry pockets are and some problem areas are. And then they go in there and they put a grid of drill holes in the ground. Go to the next slide. What you're seeing here is an image showing you the wells or drill holes or injection wells that they put in to a heap leach. So the green X's are each injection holes. And then the circles that radiate out from each one of those, that's basically the radius of influence around the injection well, each one of the injection wells. And they do this in a way such that they overlap, the circles overlap, so they make sure they thoroughly leach the pad. Okay, and down here on the bottom, you can see a truck with pipes and whatnot going out. That's one of those JEX units. And each one of those pipes is going out to one of those injection wells, okay? And it's pumping solutions down into that well. I'll show you more here in a minute. Now, the scale is real important here, okay? So the scale of the circles is about 25 to 35 meter radius, okay? So basically, a circle is not quite the length of a football field, maybe half the length of a football field, something like that. Okay, but that gives you a sense of the scale. So you need about one injection well for every half of a football field, something like that. All right. And what the company does is they call that a zone, a unit. A zone is basically their economics of the whole process is driven around one of those circles, one of those zones. All right, go to the next slide. Okay, here's a cross-sectional view that shows the injection well, the blue pipe there. Look, the perforations are basically just perforations, small holes along the pipe. These pipes are designed to be resistant to degradation in solutions and stuff. So they're made of special alloys that prevent the metal from rusting. And there can be different levels. I mean, this just shows you a schematic image. You can have like many different perforated pipes down the length of the injection well, and the injection well could be tens of meters, even over 100 meters in some cases. But they always stop the thing short of the bottom of the liner. You don't want to puncture through the liner at the bottom of the heap because then the fluids can get out. Okay, that would be bad. So they stop 10 meters above the bottom of the liner. Okay, but this injection well is now in a position, it is so simple, guys, it's crazy. Okay, it is now in a position where they can inject pressurized fluids that go out into the material around the pipe, even into those dry areas that were channelized, that didn't see fluids earlier. Those get saturated with fluids. And in fact, they get irrigated with fluid very, very quickly. Okay, so not only can you use this for irrigating old heap leaches and trying to get that residual recovery out, you can also apply this to new heap leaches, that are just freshly stacked, and make sure you get all of the metal out from day one, and you get it out much quicker because you're injecting the fluids through this thing. It's going like lickety split. Okay, so this has a huge impact in recovery. You go from recoveries of 50, 60% in many heap leaches to recoveries of nearly 100%. Okay, You can scavenge metal out of old heap leaches. You can quickly recover metal out of new heap leaches. It's unreal. Okay, this will change the whole copper space and the gold space. All right, go to the next slide. Okay, so you're going to recover more metal. Period. You will see recoveries more like 90 to 100% in the heap leachable or soluble metal in the rock. You'll see it come out. It speeds up recovery. It helps to stabilize the pads, because when you have a nice even distribution of fluids and stuff, it actually helps compact and stabilize the pad. And it also reduces the amount of time that's needed to go to reclamation, because you can pump fresh water through the irrigation, the injection wells at the end, and you can rinse the heap. That's crazy. Okay, that means you can actually rinse the heap in preparation for closing the heap and recontouring it and making it, into a usable landform. This is crazy stuff, but it's so simple, but it is what this company does. And they have the patents that cover this. Go to the next slide. Okay, any copper that was lost is recoverable, basically, by hydrodex. Okay, what does that mean? Well, when they, in the old days, like Morenci or something, they might have stacked a bunch of oxide copper, grading 0.5% copper, and they might have got 60% recovery. So call it, 0.3% of the copper came out. That still means there's 0.2% of the copper left. This thing goes in and gets that 0.2%. 0.2% is a lot of copper. We're talking about, 4 or 5 pounds of copper, something on the order of 20 odd dollars of metal that comes out of each ton. And by the way, a cubic meter is about 2 tons. So, you get a sense. You're talking about $50 for every cubic meter of heap leach that, has, $50 of metal comes back out. That's incredible. Okay. But they charge, their whole structure is around charging on a per zone basis. Okay. So there's a base fee of $5,000 per zone, but then they also have a 20% surcharge. And I don't want to spend too much time going into the details of the economics here, rather than conveying to you the technique. But this is their business structure. It's to charge on a per zone basis. How many zones are there around the world? Billions. I mean, like, truly. It's crazy. Okay, so go to the next slide. All right. So this is why I put the disclaimer slide in, because this is talking about economics here. But it is very conceivable that these one unit can generate over $10 million of profit per year. Okay. And we're not talking about a company that's going to install one unit. We're talking about, a company that has a goal of getting 50 units out within the next 3 to 5 years. Okay. That's a bunch. Okay, this company can basically produce, revenues and then profits in it equal to many of those big copper producers I showed a few slides back. Wow. Okay, crazy. Go to the next slide. I shouldn't say that they're going to produce the copper. They will produce the copper for their clients. Okay, very important. But it does generate that kind of return for JEX. Okay, that's incredible. All right. You can see one unit, if it's utilized, and migrated and stuff, one unit can generate a net of $100 million per year in revenue. That's crazy. I mean, this is how economic this is. It's wildly economic. You're probably talking at about something that's going to produce copper at sub $1 per pound. Okay, out of stuff that's just sitting there. You don't have to pay for mining it again. It's sitting there in a heap leach. You just go in and getting the metal out. Go to the next slide. Okay, so the company presented, their picture of what could happen to the copper industry. Like 100 billion tons of copper is under leach globally right now. I mean, like right now, if you look around the planet, there's big piles of rock all over the place in Chile and Arizona and that have 100 billion tons of material under leach. Some of it's being leached, like it's freshly stacked. Some of it's residual, like historic leach, whatever. But there's a lot of opportunity here. The point is they could put literally zillions of these machines out and do this thing on a bigger and bigger scale. Okay, now they already have deals with a lot of big companies. They've got Freeport, like I said, but they also got Codelco, Anglo-American. I think Glencore and Grupo Mejio are also involved. But this gives you a sense of scales, and it's almost talking like crazy talk over here on the right-hand side. You can read the numbers and get the impression. I'm not going to be too crazy promotional, but this is one of the most amazing things I've ever seen. Go to the next slide. Okay, gold. Same look at gold. Okay, there is a lot of, we'll say, heap leaches out there, either old heap leaches that need to be rinsed or scavenged, or there's new heap leaches that could benefit from this. And basically, Jex sees opportunity to get into around 50% of that heap leach market that's out there. Okay, and you can see once again the types of dollar amounts we're talking about. The number of zones, 1.6 million zones. So 1.6 million of those cylindrical zones in heap leaches scattered around the planet over 17 years. Look at that. That's crazy EBITDA. That's just nutty numbers. Okay, this is a growth business. Okay, it's private now. It will grow. It will probably go public. We're in early. You want to enjoy the stake in this, talk to Crescat, right? This is the kind of thing we do. Go to the next slide. Uh-oh. Did I freeze up or did you freeze up?
I don't see. Hold on a second. I'm going to move Nathaniel. Here you go.
Yeah. Okay. Now I promised I'd talk about one public company, and we got 8 minutes till the end of trading. So I'm sure people are going to go, jump on their iPhone. Okay. Look, Red Canyon is an investment we took recently. It's a relatively new company. It is going to be focused on copper. I'm not going to do a deep dive of it today, but I wanted to talk about it because they have a very important project that they announced some news on that I think, for the benefit of folks listening, that we're excited about. We want to see them drill it, and I think there's a lot of room for this company to make a big discovery. Go to the next slide. Just real quick, the share structure is very tight. Okay, only 34.9 million shares out at the moment. Market cap's a piddly little 7 million. Let's go to the next slide. A lot of these names, like Wendell Zerb and Alistair Waddell, are folks that you've probably seen associated with Inflection Resources. So same team here. Craig Hart, where have we seen his name? Snowline. Okay, Craig's one of the smartest guys I've ever met. He's the brains behind the reduced intrusion model, and he is very smart at looking for any deposits associated with igneous intrusions. Okay, and he is advising the company, but he's also, he's their chief geoscientist. Let's go to the next slide. Okay, they have a collection of properties in North America. Some are in BC, some are down in the Great Basin, in particular Utah and Nevada. I'm only going to focus on the Kendall project up in BC today, but the thing I would point out here is they got a portfolio of high quality copper projects, and given the track record they have, this team has with Inflection down in Australia, I wouldn't be surprised if they kind of put something together where they work with a major mining company on an earn-in structure or something over time. That's certainly a model that could happen. Go to the next slide. Okay, Kendall. Kendall is up in BC. It's actually near Terrace, BC. It's within driving range, and it is a porphyry system. This is a beautiful schematic diagram. Actually comes from Jeremy Richards, a well-known geologist who passed away a number of years ago. But I love this picture because it shows how a porphyry forms. It's basically in a sub-volcanic environment. And these guys think that Mother Nature has eroded down to the tippy top of the porphyry system here. Now, why do they think that? Well, let's go to the next slide. Now, they put news out this week talking about some data they collected at Kendall just recently. And I want people to focus on this because this is one of those swing for the fence type stories, drill stories, that's going to be coming up here over the next few months. People should be aware of it. You can see over here on the left, we're just to the northeast of Terrace. In fact, it's like a 10-minute drive from the airport. There's a huge alteration field over here on the right-hand side that's been recognized for quite some time. Why it hasn't been explored properly, I have no earthly idea. But here it is. It's about 2.5 kilometers across. It is a big alteration cell that has good copper values in streams. Go to the next slide. And the team has done a very detailed analysis of the chemistry of the rocks in this area to understand, and this is where Craig Hart's value comes in, okay? This is a very detailed model of the chemistry of a porphyry deposit. And because they can look at the elements that are present in the rocks at the surface, they can pretty much estimate, hey, we're right at the tippy top of this potential copper porphyry system. And that's the sweet spot. Okay, they can poke some holes down in here and literally find a brand new virgin high-grade copper gold porphyry right underneath everybody's nose here in British Columbia. They've done the work. Let's look at the details. Go to the next slide. Okay, the two images up here in the upper left show you elements that are depleted, so elements that have been leached out by the hydrothermal system, and then elements that have been enriched, that have been put into the rocks in that area. And this is the kind of pattern you would see with a well-defined porphyry at that very important level, just above the porphyry system. Okay, so they can come in here now and they know, boom, right there, they can poke some holes down with, like, they will tag a porphyry copper deposit at just below the surface, maybe a few hundred meters, 200 or 300 meters. The images over here on the right show you stockwork veining, so crisscross veining. This is the kind of veining we would see with porphyry. It also shows you the pinkish middle around the margin of the vein. That's potassium feldspar, so we have potassic alteration here. That means we're in the potassic zone. It's very important for finding ore. We are not far off from a discovery here. I really think these guys could come, deliver this goods this year with their first drill program. Let's go to the next slide. Okay, updates. I got to really put skates on here, but Snowline did one of the most remarkable deals I've seen for an exploration company. They basically consolidated after, and look, without going into the details, it was painful, but they consolidated 100% ownership in all of the white area that you see there. So that Venus and Jupiter, Einerson property, which is in white with an outline, that was consolidated. There was a 30% owner, and they bought him out. They bought him out for bugger all. It cost them 1.2 million Canadian and a share payment of a little over $1 million Snowline shares with a 4-month hold. That's the deal of a lifetime. Why? Because Jupiter, this discovery that was made just 3 short years ago, sits right in the middle of Einerson. Okay, we have a discovery that we haven't been able to talk about for 3 years. Okay. Think about that. They've made the discovery of Valley. It's wonderful. Hooray. But we haven't been able to talk about Jupiter. We have holes there well over 100 gram meters, somewhere in the hundreds of gram meters. We can now get back there and drill the thing. This is exciting. Basically, they've cleared the way so that they can get back to work at Jupiter. That means the value of the company can only go up from here. And they also have this optionality now where if somebody came in, let's say, and made an offer to buy out Snowline for Valley, they could spin out and they still have a massive discovery here at Jupiter. I think this is one of the best grassroots discoveries I've seen in ages, aside from Valley. Okay, and they have them both in their inside their portfolio, and they have 100% ownership. Wonderful, wonderful job, guys. Go to the next slide. Another land deal. Look, Sitka announced they cleared out and took 100% ownership of the Barney Ridge property, which is on the west end of their claim block. You can see over here on the right-hand side, Barney Ridge, it was a small part of their bigger land block, but it does have some of the reduced intrusions in there. You can see the Clover, Lucky Charm, and Leprechaun zones. These are great undrilled targets, reduced intrusive targets, much like those at Blackjack and Eiger. Now, you say, well, geez, what's the big deal about this? You know what? The only time I've seen companies do this, like go out of their way to clean stuff up and make sure they got 100% ownership, is because they know they got the goods. Okay. That's my take. Okay. When a company knows it's onto something big, it likes to clean up, all the land issues that it has. So to me, this ushers in the likely, and a likely outcome that Sitka will announce something, big as time goes on. Let's hope. Next slide. Okay, otherwise known as highway robbery, Newfound acquired Lab Gold's Kingsway project up in Newfoundland. The blue is the Kingsway project. You can see this does include a portion of the Appleton Fault Corridor. They basically bought it for $20 million in shares. And it gives Lab a very big treasury. But I think at this point, what the takeaway from this is that this consolidation gives Newfound a commanding position on this gold belt. All right. It also probably puts Newfound in a better position to be a takeout candidate. Think about it. They basically cleaned up a discombobulated land situation. Now it's cleaned up. But it also gives them a lot of new ground to go out and drill and test. And we already know the guys at Newfound have kind of the secret sauce, technical sauce to go out and make discovery. Okay, so I think this is an excellent deal for Newfound. For Lab shareholders, it means that Lab will likely use its treasury to go off and hopefully find a new project or do something that creates value for its own shareholders. All right, go to the next slide. Okay, Line 1 put out an update this week. It's been a while since we've seen an update, but you can see they had phenomenal drilling in infill out of Zone 2. Some just bonanza grades once again. There's numbers in there in the hundreds of grams per ton, and that's what I would expect from a system like this. But the highlights from the operation side, a lot of people read this and they go, what on earth is this? Like 2,630 meters of sludge hole drilling complete. Okay, what does that mean? They're basically drill defining the URW1 and Morale loads in Zone 2. They are air leg mining of the UR2, so they got production stopes going, and also in Zone 5. Okay, so they got production stopes going. That's big because most of the work previously was in development stopes or development drives and stuff. They will have 2 long hole drills coming soon. I think or they have those commissioned. Long hole is when you drill big holes down a gold bearing structure, and then you basically blast your way back up. So it's a cheaper way of mining. Think of it that way. Anyway, they're now capable of doing long hole drilling and stoping. They are going to have 2 remote capable loaders in May. That'll help make loading tons more efficient, get the tonnage up. Why? Because they're trying to get up to the 500 tons per day or 500 plus tons per day. And they're also upgrading the CIL circuit with blowers. They basically inject air into the solutions to help foster solubility of gold. Okay, so what is the company doing? They're moving forward. They're making hay. Be patient. I think they'll deliver. I'm confident they will pull something off here. Let's go to the next slide. Kuya announced discovery of high grade to the south of Bethania in a new area. I think this is intriguing because they are already, ready to resume operations at Bethania. That's the first bullet up there. But the veins down at this Tito PH, which is 1.5 kilometers to the south, yielded some very high grades. You can see 12 of 39 samples reporting over 1,000 gram per ton silver equivalent. All right, so this is a new vein system they can sink their teeth into, probably put drives in fairly quickly, and hopefully develop into a producing mine. Same at Carmelita Norte. You have a very high grade up to a 1,200 grams per ton silver equivalent there, and 12 samples in excess of 500 grams per ton silver equivalent. So the story is coming together at Bethania. This is where Kuya started, and I'm glad to see them actually get to the point where they're going to be in production, but also able now to pull in some new discoveries and make a bigger and bigger story out of this. Go to the next slide. Okay, the last company today is Red Pine. I realize I might have missed one or two, but I'm already way over time. But Red Pine intersected very good results at the Wawa Gold Project. You can see 5.34 grams over 13.4 meters. These are basically infill and step-out holes or incremental step-out holes around the Surluga area here, and you can see the details over on the right. But what I really want to point out, and I think I touched on this in another presentation recently, Mikhail Michaud has joined Red Pine as its president and CEO. Folks who know him, he was at Wesdome. He was kind of had the Midas touch there at Wesdome a few years back. Managed to help find that high grade. That's his specialty is near mine and development level drilling and work that needs to be done like here at Red Pine. and he made Westom a huge success there. So let's see if he's got the Midas touch here at Red Pine. Okay, guys, I realize I went long, but that's it for today.
All right, thanks, Quentin. So once again, if you're interested in learning more about our strategies here at Crescat, our global macro fund, our long short fund, our precious metals fund, give Merrick Iwahashi a call. Reach out to him, shoot him an email. We'd love to hear from you, and we're happy to give you more information and find out about your situation and how our strategies might be a good fit for you. Tavi, any final comments?
I don't have any final comments, but we'll be back next week with more videos. If you enjoyed this video, please subscribe to this channel as well so you can get notified. We should be back next week. Should be a normal video, hopefully. So, but thanks everybody for watching. And again, if you have any questions about Crescat, I would highly suggest you to talk to Merrick, and his information is on the screen. Anyways, thank you very much. Thanks, Kevin. Thanks, Quentin. And we'll see everybody next week. Take care.